You had a plan, and it looked clean. The level made sense, the setup made sense. The move you expected also made sense. But then price did something else. It did not react where you wanted it to react. It did not respect the level. It did not follow the path you had in your mind. And this is where trading becomes uncomfortable. Not because the plan was bad, but because the trader starts to feel like the market should respect it. That is the real test. A trading plan can make you feel prepared. It can make you feel calm. It can make you feel in control. But preparation is not control. The market does not know your plan. It does not know how long you waited. It does not know how clean the setup looked before it failed. And many traders are not tested when they create the plan. They are tested when the market refuses to follow it. A trading plan is important because without a plan, a trader is usually just reacting to candles, emotions, and pressure. So this video is not about trading without structure, and it is not about pretending that planning does not matter. The real problem begins when the trader becomes emotionally attached to the plan. At first, he only says, "This is my idea," but very quietly, that idea starts becoming something stronger. It turns into, "This should happen." And once the mind says should, the market starts to feel personal. Now, a normal invalidation can feel like disrespect, and a simple rejection can feel like the market is proving him wrong. Instead of reading what is happening now, the trader begins defending what he wanted to happen before. That is the quiet trap, because the plan was supposed to guide him, but now he is protecting it like it is part of his identity. And once a trader protects the plan, more than he protects his discipline, the chart is no longer the only risk. Before the trade, everything can look calm. The chart is still, the levels are clean, and the idea makes sense. Maybe price is near support, maybe there is a breakout area, or maybe there is a zone where the trader expects a reaction. In that quiet moment, the mind begins to build a story. If price comes here, I will enter. If it reacts there, it should move higher. If this works, this could be the trade that finally plays out cleanly. There is nothing wrong with planning like this because a trader needs scenarios. He needs preparation, and he needs to know what he is looking for before emotion enters the room. But there is a big difference between having a plan and believing the plan is already true. Before price confirms anything, the plan is only a possibility. It is not a promise, and it is not a prediction that must happen. It is only a map for one possible version of the market. And the danger starts when the trader forgets that. Then, the market starts moving, and at first, it may look close. Price comes into the area, a candle reacts, and for a few seconds the trader feels confirmed. The plan still feels alive, and because it almost works, the mind wants to stay attached to it. But then something changes. The candle closes weak, the level does not hold, the breakout does not continue, and the clean reaction becomes messy. This is the moment where the trader has a choice. He can accept that the plan has not been confirmed, or he can start negotiating with reality. The dangerous part is that this negotiation does not always sound emotional. Sometimes it sounds calm and reasonable. The mind says, maybe give it more time. It says, maybe this is still valid. It says, maybe the market is just shaking people out. But maybe is not confirmation. And when the trader uses maybe to protect an old idea, he is no longer following the plan. He is following attachment. This is the moment where a small problem can grow into a much bigger one. The trader checks another time frame, not because his plan requires it, but because he wants to find something that agrees with him. He redraws the level, adjusts the story, and slowly moves from clear rules into emotional interpretation. From the outside, it may still look like analysis. He may still be looking at candles, zones, and structure, but inside something has changed. Because he is no longer asking, what is the market showing me? He is asking, how can I keep my idea alive? That question is expensive, because when the goal becomes proving the plan right, the trader stops being flexible. He stops seeing fresh information, and he starts fighting the chart. Not because the setup is strong, but because letting go feels uncomfortable. The market does not reward emotional loyalty. It does not care that the idea looked good, that the trader waited all morning, or that he wanted this setup to be the one. The market only shows what is happening now, and the trader either accepts that information or turns his plan into a fight. A strong trading plan is not there to force the market to behave. It is there to tell the trader how to behave when the market does whatever it wants. That is the shift that many traders understand late, because they think the plan is supposed to create certainty. But the real purpose of a plan is not certainty. The real purpose of a plan is protection. It should define what confirmation looks like, where the idea is invalid, when to wait, when to enter, when to step away, and when to admit that the market has not agreed. A good plan protects the trader from chasing every candle. It protects him from turning hope into analysis, and it protects him from staying inside a bad idea just because he spent time building it. The plan should not make the trader rigid. It should make him clear. A plan is not supposed to make the trader right. It is supposed to keep him disciplined when being right becomes tempting. And once the trader understands that, an invalidated plan no longer feels like an attack. It becomes useful information. But there is another trap here. Some traders here adapt and think it means changing their mind every few minutes. Price moves up, so they become bullish. Price drops, so they become bearish. One candle appears and the whole plan changes. That is not adaptation. That is reaction wearing the mask of flexibility. A trader who changes every time the market moves is not free from attachment. He is just attached to the latest candle. A patient trader adapts differently. He does not marry one idea, but he also does not chase every new one. He waits for new information to become clear, lets the invalid plan die, and does not instantly replace it with another emotional trade. This is where discipline becomes quiet. The trader can say, "My idea was not confirmed, but that does not mean I need a new trade immediately." He can return to observation instead of rushing into the next opinion. Because the market can reject your plan without creating a new opportunity. Sometimes the best adaptation is not changing direction. Sometimes it is doing nothing until the next clean decision appears. The market does not care about your plan, but that does not make the plan useless. It makes the plan even more important, because when the market does not care, the trader needs something that keeps him from becoming emotional. He needs structure that reminds him what he controls and what he does not. He does not control the next candle, the reaction at his level, or whether the setup becomes perfect. But he does control whether he respects confirmation, whether he accepts invalidation, and whether he turns one rejected idea into 5 emotional decisions. That is where the real trading skill lives, not in making a perfect plan, but in staying clear when the plan breaks. Anyone can feel disciplined before the market disagrees. But the real test begins when the market gives information the trader did not want to see. The trader who can accept that information without defending his ego is already different. He is no longer using the plan to demand something from the market. He is using the plan to manage himself. A patient trader still makes plans. He still studies the chart, waits for levels, prepares scenarios, and looks for clean setups. But he does not ask the market to obey him, because he understands that the plan is a guide, not a guarantee. When the market agrees, he can act. When the market refuses, he can step back. When the idea is no longer valid, he does not need to defend it, because the goal is not to prove the plan right. The goal is to protect the trader from becoming wrong in a bigger way. That is why he can make the plan, respect the plan, and still let the plan go when the market does not confirm it. Your trading plan is not a promise. It is a guide for how you behave when the promise in your mind gets broken. And once a trader understands that, the market can reject his idea without taking control of his behavior. If you like this video, please like, comment, or subscribe to The Patient Trader.